Hi everyone and welcome to today's morning report on Friday the 4th of September with me, Rich Perry, market analyst at Handtech Markets. It is non-farm payrolls day and the markets are actually lower at the moment. FTSE down 1.2%, DAX down 1.5%. Markets are seeing a safe haven drive and that's come out of the Asian trading really. And that's pretty much, I think, the concerns ahead of this payrolls report in terms of what it could mean. It's a pretty crucial report, actually. It's the last key bit of data, really, in front of this FOMC meeting for September. A strong payrolls report could mean a rate hike for the States. And that is certainly playing out in these markets today. Safe haven trades, yen is stronger today, almost coming up to almost 1% stronger, over 100 ticks down on the dollar yen, and also treasury yields as well. Let me just show you the charts on this. Treasury yields falling away as that safe haven play continues today. Interesting also that we've seen oil price, which has been so volatile in the last few days, but oil price lower as well. That's sort of playing into this whole safe haven move as well, into equity markets weakness. The dollar has been very choppy actually. The 96.3 pivot level on dollar. Trade weighted dollar that I've talked about still continues to be tested on this, as we saw the dollar strengthen yesterday. Still, that is in place, but obviously the euro bouncing today slightly, about 30 ticks higher, 111.50 as I speak, and that is certainly not helping that dollar trade weighted chart. But certainly, I think that these markets, are generally speaking, are pretty much on the back foot ahead of this payrolls report. Um, You've got the payrolls report that comes out 1:30, and the expectation is that the headline number will be increasing slightly to 220,000. But I think you're going to need a pretty much a blowout report, I think, to really sort of drive the Fed to raise rates in this environment. Markets are so volatile at the moment. Market turmoil, every bit of Chinese data that comes out is negative, and I think it's really is a concern for these for the Fed still. And I think that the Fed is still dovish, and I think that that's going to play into that. So it really would need a very strong payrolls report today, I think, to persuade them to hike in September. Having said that, unemployment is expected to fall to 5.2%, and also average hourly earnings is oh, that chart is not coming up annoyingly. But anyway, average hourly earnings is expected to come up at 0.2% for the month, which would actually be a slight improvement on the year-on-year earnings growth to 2.2% there. But I still think you'd need a lot stronger payrolls report to drive that Fed decision to be a rate hike. So my chart of the day is the Kiwi dollar. And we've had this sort of breakdown from this trading range on Kiwi dollar. Actually, sort of the implied target has actually been hit around 60.50. I think sorry, 62.50, around there or thereabouts of that downside target, and that pretty much got hit straight away by that spike lower on the 24th of August. And since then, you've seen that old support becoming new resistance around 65 big figure, and you've had this continued falling away. I sort of spoke about in the morning report that I think that, just looking bigger picture really on this Kiwi dollar, look at this bullish divergence you've got forming here. Let me just get this bullish divergence going on this chart. You see the lower lows on the price, but the higher lows on the momentum indicators. Also, that is, you could argue, that's showing through on the stochastics as well. MACD lines are not as negative as they were. It'll be very interesting to see if the Kiwi starts to turn up now, because those momentum indicators will react to that, I think. Now, the key for this in terms of a turnaround would be a move above 65 figure. That is obviously the key overhead resistance in place, and I think that would need to be seen for a serious recovery to start taking hold. But at the moment, obviously, the selling into rallies continues to be a viable strategy. But on the caveat to that, you would still argue that the momentum indicators on the daily chart are suggesting a bearish sorry, a bullish divergence. This is the hourly chart, and you can see the continued sort of use of old support becoming new resistance, again coming in around that 64 figure level over yesterday before falling away. So that is again an initial line of resistance, but 65 figure I think is that key level on the daily chart that you need to watch out for, that really would suggest that we're starting to see something. Now, in terms of your supports today, obviously you've got payrolls day, so it's going to be a lot of volatility. Any strong payroll support is going to see this absolutely to the downside again. 63.10 is your sort of key level, I suppose you'd argue. 63.30 is an initial support, but certainly it would seem that in the last couple of days you're starting to try and form some sort of support. Whether the payroll support blows this out of the water or not remains to be seen, but certainly it has been, in spite of some dollar strength actually. You're seeing this support coming in on the Kiwi dollar, so very interesting to see how this one plays out. But obviously, payrolls report today, lots of volatility, and I wish you good luck in your trading. Thank you.